ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. Back at the desk. It's been over a week. Actually, it's been over 10 days. Good to see everybody out there. First trade show for me of the year, the Independent Mortgage Banker Show, put on by the Mortgage Banker Association in Coronado Island, down in San Diego, the Del Coronado Hotel. Man, it's great to be back at my desk, and I am buried. So I apologize. I'm going to try and get through a lot of this stuff here quickly if I can. I got a lot to cover. It is a massive news week on the macro picture. But let's talk about some industry news. It was a huge virus that was uploaded into the Encompass system. Did anyone else log in and notice today that somebody had photobombed it? All kidding aside, I am very appreciative, and I really love the ICE team and the marketing team. I had no idea they were going to put Dale Vermillion, who is the PRMG sales coach guru. He's at all of our events, and he's founder of Mortgage Champions. He and I cut some content back in June for ICE in Atlanta, and that was the pop-up when you logged into Encompass. For those that are not originators or on Encompass, Encompass is the leading LOS system in the industry as far as independent mortgage bankers. And so I'm sorry that you had to see me this morning. I'm flattered. ICE, thank you for doing that. And hopefully you actually clicked on the Monday motivation video. Here's your Tuesday motivation video. So thank you, Team ICE. We love you. Okay, so what's going on? Well, there's the Fed speaking this week, and it's kind of like, a massive, massive deal. And one of my macro trends that I'm looking at this year is how will this new board that is made up of what's supposedly more dovish versus hawkish voting members. So we have new voting members. This is their first time this year to vote, and we will see what they say when everything gets released on Wednesday. So the meetings start Tuesday, and then Wednesday they come out and they have a Q&A. And so the CME tool that I always look at has a pretty high probability of showing a 25 basis point hike this week on Wednesday, and then again at the March 22nd meeting where they actually announce on the 23rd. So the Fed, if they really want to shock the market, if they really want to hurt us and inflict pain like they've talked about, they can crush the wealth effect by going 50 basis points this week, which absolutely the entire market is on the opposite side. I mean, it would catch the entire stock market off guard. They are not expecting a 50 basis point rate hike. I don't think that's going to happen. But if they really want to inflict pain and kind of speed this whole thing along, they could do that. But, I think that the fact that they have gone less than 75, they've gone 50, and now potentially will go 25, says that they are aware that inflation is coming down. They are aware of current data. They aren't using lagging data. And they have all the data. And these guys aren't idiots. And so it doesn't mean they'll get it right. They have one thing to do, really, which is raise rates. And by raising interest rates, they are trying to suppress consumer demand, which is 70%, 68, 70% of the economy and the gross domestic product, the GDP, is consumer demand. And if things that have a higher cost, like buying cars, buying houses, getting loans, credit cards, anything that's interest rate sensitive, if there are higher interest rates because of the Fed's action, then the demand for those goods and services that are interest rate sensitive will come down. Thus, there's less economic growth. Thus, we potentially go into a recession. And if there's less demand for what was a shorter supply of goods, certainly as exposed by the pandemic, then that's how inflation comes down. And when inflation comes down, mortgage interest rates come down. So it's this whole domino effect. The Fed is the one fighting inflation. and they're doing it with the one thing that they have. Of course, they can, reduce their balance sheet as well with treasuries and mortgage-backed securities. And there's the repo market, which is kind of like a place for institutions to park their money. We've talked about that quite a bit. It's a way to get, quick overnight funds and put cash aside for institutional markets. Very fascinating, actually. The last day of the year, last year in December, the single biggest day of institutions putting money into the Fed repo facility. There's a repo facility and then a reverse repo facility. It was like $2.5 trillion of money parked in a day. Biggest number ever in one day. Had a lot to do with end of year, end of quarter, all kinds of stuff like that. Fed was totally unbothered by it. Anyway, so the Fed is going to make a big deal this week in trying to fight inflation. And the GDP reading came out for Q4. And the GDP for the fourth quarter grew by 2.9%. So good news, right? Wrong. Everyone says, well, it's not really good. And here's why it's not really good, because it mostly has to do with like trade and things that don't really count. Because if you look deep into the numbers, it's not that it's good, even though the entire year we had a 2.2% GDP for the year. But that's not going to be good because consumer spending was down, which we just said is 70% of the economy. So consumer spending is tapering down as the year winds down, which if there's no, trade wonkiness that goes on, like, for example, what did our buddy Elliot Eisenberg say? That the trade deficit is a big part of why GDP grew. But if that reverses because demand comes down because of these things that we're talking about, and then obviously consumer spending is going down, credit card spending is going up, people don't want to get rid of their lifestyle, then you start to have defaults, then you have job losses. It's this whole spiral, right? It's out of control. And I think that's what the Fed wants. The NBA, who put on the show last week, they have a forecast. They are forecasting a recession for the first half of 2023. So they're still forecasting a recession within the first 6 months. Well, 1 month's over, pretty much. And they are forecasting that interest rates will be at 5.2% by Q4, which would be down from the current, let's call it 6.15%, the Freddie Mac rate. So, in this fight for inflation, the $1.7 trillion bill that the government passed doesn't exactly help in that, although government spending has been coming down, other than this bill passed, but it's been coming down this past year. And so when we're talking about inflation, we're talking about a recession, we're talking about the authority, the conference board, they have this leading indicator that they put out. You can look it up. It's called the LEI. I'll go over it real quick. There was a decline of 1.1% in December, and there was a 1% decline in, 1% decline in December and 1.1% in November. So the last 6 months of the year, the leading economic indicators have had a 4.2% decline. And so that's a very steep decline, led by consumer spending less and less. So we'll keep an eye on that. Analysts are watching earnings. It's earnings week. Have a pretty cool stat to show you here. I follow StockTwits. It's one of my places where I get information. And here are some of the earnings companies that are coming out this week. Caterpillar, which is absolutely like an infrastructure spending company. I mean, are people buying tractors to build stuff? Cat reports in just a couple hours before the market opens. Huge bellwether on the economy. They're like Dr. Copper, which is up lately. GM, McDonald's, Pfizer, UPS, ExxonMobil, like they make all the oil. Is oil going to go up? That's a huge macro trend I'll be looking at this year. And then the big tech people, the sexy stocks that are out there, Meta, Alphabet, Amazon, Apple, all coming out this week. We got job opening report. We got, of course, weekly jobless claims report. We have price index to home. The Case-Shiller price index is out tomorrow, and the big jobs report on the first Friday of the month from the Bureau of Labor Statistics. All this stuff and earnings and a Fed meeting all in the same week. my mind is blown. Yes, it's not just the espresso. It's the fact there's so much data coming in, and we're going to have a lot coming our way. The FHFA increased a bunch of loan level pricing adjustments, and one of them was to make a DTI, debt-to-income price adjustment on locks. That's going to be really hard to manage with income docs going in and out, back and forth. Going to keep tabs on that one as well. Have a good week. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.